Welcome back. Now, Equites Property Fund has posted strong interim results supported by robust rental growth and disciplined capital management. Equites CEO Andrea Taverna-Turisan says the overall quality of the group's portfolio has improved through the disposal of older non-core assets and the addition of new ESG-compliant properties. He joins us now for greater assessment of the performance. Andrea, thanks so much for your time today. Now, you've kicked off the financial year on a high. Vacancies are low. Property values are rising and distributions are up. What's driving the performance? Is it mostly strong market demand or more about how you're managing your portfolio as well as operational efficiencies?
Well, I think, listen, there's no question that the sector that we operate in, and I'm talking across the whole sector, so we tend to operate in the more sort of top end of it, if you like, with the A-grade facilities, the ESG compliant facilities, but the whole sector is in really good shape. I mean, you know, the vacancy across the sector is 1.8%. I mean, I've been involved in the world of logistics and industrial properties since the year 2000, and I've never seen vacancies as low as they are today.
Yeah.
So invariably, I think most landlords that made the decision to be in this sector, I think will be in a very happy space at the moment. And I think we're no different. Strategically, obviously, we've made the decision that we want to be at the top end of the market. We're driving innovation. We're driving dealing with predominantly blue chip and multinational organizations. And it's a strategy that I think is paying really, really good dividends. We've got this fantastic base portfolio. We keep on adding to it. And we've made, you know, I think the big decision to repatriate our capital from the UK because we feel we've made our money there. We've done extremely well there in the last 9 years. And the deployment of fresh capital into new opportunities, the numbers just don't stack up for us based on the cost of our equity and potentially the cost of UK debt. So the combination just doesn't work for us. And you know, fortunately, we're coming out of a market that has got very, very deep liquidity. And even though the UK is probably not in the best shape it's ever been, notwithstanding that yet, you know, we are going through a process where there is significant interest for our assets. So a very, very exciting place to be at the moment.
And just on the UK, just take us through where you're at with that disposal program. And once it's wrapped up, that officially marks the exit of Equites operating in that country, right?
That's correct. I mean, I'd like to think that, let's say, by September next year, we hopefully will be out lock, stock, and two smoking, as they say. But you know, ultimately, that we're in no rush. You know, the base assets that we've got are high quality. They're still delivering. We completely hedged out with debt in the UK, so we have no interest rate risk there in the medium term either. So we would like to repatriate, but the repatriation of those funds will also have a massive impact on balance sheet. You know, potentially taking loan to value into the very low 20s, which in a weird kind of way makes the balance sheet maybe even a bit too lazy. And consequently, you know, we want to do things in the way that we create the most shareholder value effectively. So, you know, it's actually quite pleasant to be in this situation because you know, you don't have a gun to your head that you have to do something. So we'll do it in our own time. We'll ensure that we create the necessary value for shareholders. And at the same time, you know, we've got a really, really good pipeline coming through the system in South Africa. But like everything, you know, when you develop things, the money doesn't all go out the door on day one. It is a process of the money being drawn down. So we have no sort of imminent pressures on balance sheet in terms of drawdown of liquidity, if you like. So Yeah, so we're having our cake and eating it at the moment, if you like. Yeah.
And just talking about, those new developments and what's in the works when it comes to your pipeline. We constantly hear about, the huge demand for logistics and warehouses, but a shortage of bulk land plots. How are you keeping up with demand when, supply is getting tighter?
Well, I mean, I think you said that very accurately there, in the sense that land, I think, is going to be the biggest challenge for all of us, and having the appropriate land in the appropriate location at the appropriate price with the appropriate services. That is going to be, I think, the one thing that's going to challenge all developers in this sector. So at the moment, we're fortunate in that we've got currently about 47 hectares of land on balance sheet, and we have access to about another 35 to 40 in locations that are highly desirable. So let's say the short to medium term is generally taken care of. We are constantly investigating opportunities to access appropriately located land with the appropriate services. Location is key in logistics, so you can't just buy anywhere. And in that, we're exploring opportunities of joint ventures. We're exploring lots of different things, and we feel that even in a joint venture situation, we bring a lot to the party, to whoever owns and controls the land. So yeah, as I said, exciting times for us. Obviously, we've got immense talent in the team as well that has really shone through in the last 2 to 3 years. The asset management team have done incredible jobs of renewing leases. They've done incredible jobs of selling off some of the older non-core business properties, as you mentioned earlier in your statement. And then the development team have done absolutely world-class work in delivering some of the best warehouses in South Africa over the last few years, and will continue to do so. And then, the unsung heroes, the billings people and the property managers, I mean, doing immense work as well. I mean, our debtors book is almost negligible. And then our property managers, whilst we've got these fully repairing and maintaining leases, a lot of people believe that we don't have to worry about our properties. The tenants will take care of it, and if they don't, they pay. But ultimately, always better to be on top of these things, and we do conditioning reports on all our properties twice a year to ensure that our tenants are aware where they're failing the property, that they're actually doing the necessary work. And in doing that, there's a level of professionalism which really entrenches those relationships with these clients, because they really see the value that we add to the mix. And having a developer landlord of an Equites ilk is, I think, is a massive advantage for any organization. But obviously, I would say that.
So the pipeline looking strong, fundamentals to the upside. But we can't lie here, Andrea. Doing business in South Africa is quite difficult, right? And, with your buildings being very ESG focused, you've been investing heavily in solar. There's been, a lot of PPA agreements as well. There's also a wastewater treatment in the pipeline. Talk to me about those sustainability initiatives, from engagements with municipalities to even how you're directing your capex towards those initiatives.
So on the solar side, the capex initiatives are great, because the return metrics on that are very good. We do it obviously because we do want to make a return, but it's not the only reason we do it. We do it also because we really are trying to create a product that gives our clients the ability to operate within the sometimes very difficult operating circumstances that are being afforded by our municipalities and our service providers across the board, from water, electricity, sewage, you name it. And as a consequence, we're constantly trying to think outside the box. What can we do to ensure that there's business continuity at all times for our tenants? Solar being one of them, but not only. I mean, we've managed to get our first approval from a municipality up in Gauteng. which is permitting us now to put our first sewage plant down inside one of our parks with a view to recycling water. Obviously, we're not doing it to potable standards. But what we are doing is we're doing it to being able to use it in the flushing mechanisms,
Okay.
and the rest. And from an Equites point of view, we always felt that the water issue was coming, and we've been building our warehouses with a double plumbing system, one for potable and one for non-potable, for about 5-6 years already. So for us to just hook in the non-potable connection from our sewage plant becomes literally a changing of one pipe.
Okay.
So very excited about that, and the consequential benefits to tenants being fully operational. Even in times of we've had some tenants that have been out of water for 10 days, kind of thing, and it's impossible to operate without water.
All right, let's leave it there. Thank you so much for your time and just taking us through the 6 months that was for Equites. Now, that was Andrea Taverna-Turisan, CEO of Equites.